Hello everyone, welcome back to our final accounts series. In today's session, we're continuing our discussion on the statement of financial position. Last time we focused on assets, but there's still more to cover. Now, we're moving on to liabilities and equity. But before that, let's do a quick check-in. Quick check. Can you recall the three main components of the statement of financial position? Take a moment to think. Yes, assets, liabilities, and capital. If you remembered all three, well done. Key formula to remember. Before we move forward, keep this important equation in mind. Total assets equals current assets plus non-current assets. This formula is essential for understanding financial statements, so make sure you remember it. Let's answer the question from the last video. In the previous session, I asked you to classify different assets. Now it's time to check your answers. Take a moment to go through your notes or pause the video before we review them together. Ready? Let's go. Correct asset classifications. Non-current assets. Tangible. These are physical assets that last a long time and help in business operations. Office building, factory, machinery. Office building. Non-current assets. Intangible. These are valuable assets that don't have a physical form, but provide long-term benefits. Trademark patent for a new product. Trademark. A business can have multiple. Current assets. These are short-term assets that can be converted into cash within a year. Inventory of raw materials. Accounts. Receivable, prepaid insurance, cash in hand. How did you do? Did you classify them correctly? If so, great job. If not, no worries. Learning is all about practice. Now that we've covered assets, let's talk about the second major component, total liabilities. Liabilities represent everything a business owes, whether to suppliers, banks, or other financial obligations. Understanding this is key to assessing a company's financial position. Understanding current liabilities. Current liabilities are obligations that a business expects to settle within 1 year or during its operating cycle, whichever is longer. These are short-term financial responsibilities. Examples of current liabilities: accounts payable, money owed to suppliers, overdraft, when a bank account goes below zero, short-term loans, borrowed money that must be repaid soon, accrued expenses, expenses that have been incurred but not yet paid, such as wages payable or utility bills. Understanding non-current liabilities. Non-current liabilities are obligations that extend beyond 1 year. These represent long-term financial commitments. Examples of non-current liabilities: long-term loans, borrowed funds with repayment over many years, bonds payable, debt securities issued to investors, lease obligations, long-term agreements for property or equipment. Key formula to remember. Just like with assets, we have a crucial formula for liabilities. Total liabilities equals current liabilities plus non-current liabilities. Make sure to note this down. It's essential for understanding a company's financial position. Your turn. Let's practice. Now, let's test your understanding. Can you classify these liabilities as current or non-current? Take a moment to analyze the following liabilities and determine whether they fall under current liabilities or non-current liabilities. Pause the video or take a screenshot and try answering before moving forward. In the next video, we'll go over the answers and continue exploring the statement of financial position. If you found this helpful, don't forget to like, subscribe, and drop a comment below with your answers. See you in the next session.